If there's a stock to own in the financial space right now, it's more than likely going to be JP Morgan, ticker JPM. My name is Hamilton. I'm here with the Trading Initiative. We're going to go through a quick trade idea here on this JP Morgan name itself. Earnings are Friday morning, right? Banks are kicking off the earnings season coming up on Friday. We have a number of big banks that are going to be reporting: JP Morgan, Citigroup, etc. And speaking of which, I want to go ahead and just paint the picture here before we dive into JP Morgan itself. The financial sector has recovered well from those March lows, the regional banking disaster here, trading north of the 200-day moving average, but by no means is this absolutely bullish from an absolute standpoint. Financials are stamping higher highs, relatively speaking, year to date, but they are still underperforming the S&P 500, which is obviously the benchmark. And right now we are starting to build a base above the 200-day moving average, but not yet are we convinced that this sector is ready to absolutely fly. So this idea itself is going to be a little bit more risky, but we are starting to see some sector rotation out of growth and into value. Therefore, this does set the stage for some financials outperformance, at least in the short term. If we look at the actual regional banking ETF itself, we saw that it did hit a low back in May and has bounced up quite well, still trading very far south of its 200-day moving average. So we don't really want anything to do with the regional banking ETF. We don't want to own this stuff yet until it's at the very minimum hitting higher highs and realistically above its 200-day moving average. Having said that, there are pockets of some relative strength, but we're going to go through some of the other large financial institutions that will be reporting at the end of this week, beginning of next week, and show you why we don't want those before we tell you why we do want JP Morgan. First things first, Citigroup looks absolutely terrible. Some stocks are moving up and to the right. Some stocks are moving down and to the right. Citigroup is doing neither, just horizontally channeling here. Looks to be somewhat of a coil price action fractal playing out here, but trading south of the 200-day moving average. No realistic indication that bullish momentum is here. We don't want anything to do with Citigroup. Wells Fargo, still underneath its 200-day moving average, has stamped out some slightly higher highs here off of the regional bank meltdown, but realistically, this is not a name that looks to be breaking out, and therefore we don't want anything to do with Wells Fargo. We're trading below its 2020 highs. We're not even above its 200-day moving average. Just not something we want to allocate any of our scarce capital towards. Bank of America. This name actually looks worse than the previous two. This appears to be building out somewhat of a bear flag, right? A sim triangle at the bottom of a move down, very far below its 200-day moving average. Once again, this is a name that we just don't want anything to do with. There's just better opportunities out there. Goldman Sachs, the same sort of idea, horizontally channeling underneath the 200-day moving average. Morgan Stanley, same type of idea, horizontally channeling underneath its 200-day moving average. But then we look at JP Morgan. For whatever reason, listen, it's not up for us to decide. If you have an idea, awesome. But the fact of the matter is, not only are we trading north of the 2020 highs, which the other names were not, we are moving up and to the right, above the 200-day moving average, and the 200-day moving average is sloped up. So this is, in my mind, the name to own of the major banks that will be reporting on Friday. You see, we have 144 as our line in the sand here for risk. We want to own this thing above 144. You can see it's previously been tested as a point of resistance, obviously is held as a point of support before as well. So for whatever reason, this 144, 145 area is pivotal for JP Morgan. If we're trading north of it, we want to own it. The 200-day moving average, as I said, sloped up, so this is supporting recent price action. It's very good for us. Bullish momentum regime is intact along the RSI. I want you to take into consideration the regional banking crisis. Everything sold off like crazy inside of this space. JP Morgan did not. We came down and tested the 200-day moving average, held it, built a base, and then broke back up. Other names did not. They broke their 200-day moving average and traded well below it. For whatever reason, JP Morgan held it. This is relative strength across the entire basket of other financial-related stocks. If we split the RSI in half, and I asked you, is the RSI trending more above the 50 or below the 50? The obvious answer is, well, above. About 80% of the time, it looks like it's been trading above going back to the October lows. That is what we would call a bullish momentum regime. Obviously, the regional banks had the RSI pop down as they did sell off, but the market quickly recovered, spit this thing back up towards 70, and it's been trending above 50 the entire time. For whatever reason, the market does not want to sell JP Morgan. This is relative strength. There's a slight low volume area above this 144, 145 area up towards 150, 151. We're going to use this area to attack the chart and potentially pad profits prior to ER. Let's see if it happens. So once again, ER is on Friday morning, and the entire trade idea is laid out. We like it above 144. The 170 area could potentially be that price target, which is up near all-time highs, and this 135 area as our stop out, which makes sense because obviously this is a very pivotal part as well inside of this fractal. You can see multiple times it was tested as support and resistance. So if we fall back below that, we don't want anything to do with JP Morgan. So let's actually go and look at the chain itself. If we pull up JP Morgan on the chain, there's multiple ways to trade this, which is what makes it kind of fun. You can buy straight calls, you can buy call debit spreads to reduce risk through the ER event, right? So let's actually go ahead and look at this. Look at the IV itself, below 50 across the board. Below 50 means we can be buying straight calls as long as it makes sense for your account capital. In the event that you buy calls and JP Morgan breaks out, uses the catalyst on Friday morning as an opportunity to absolutely, blow out all the shorts, you're going to get a two-way win here on IV expansion and the directional play itself being long. So there is a basis there for buying straight calls. IV rank is 12, so historically this is low. IV itself is low. Calls are available here, all right? So let's start with the Octobers. So we were looking at that 170 area as a potential price target. I believe the October expiration itself is too soon. There's not enough time there for this thing to actually get up towards that 170. So if you're looking at playing a closer date as a swing trader, those Octobers are the closer date. I'm looking at these 160s, potentially the 155s. Right now, the 160s you can grab for, let's see, $1.64. That's your max loss if you were to buy this. Max profit, obviously infinite, but there's an opportunity here because you're right near that 0.25 delta. It makes sense if you want a straight call here. The October 20s will put you in place for that ER event. I have no idea which way the market's going to take the ER. Have to point that out. But this is a decent, cheap play to grab exposure for that potential volatility event on Friday if JPM does break out, right? The 160s make sense. There's enough time there for price to get in the money. This play will work if you want it. But let's actually go out a little bit farther. The Novembers, realistically, I like the Novembers or Decembers the most. You can look at the 160s once again, but we can also look at the 165s. So the 160s here you can grab for 228. You could spread these if that's too much, right? If your account capital, you don't want to risk $230 per contract, you could spread this to 160, 165s. This allows you to capture near that 0.25 delta. It's going to cost you $93. So that's your max potential loss per position, right? Per pair of contracts. $93, max profit of 407. That's greater than a 4-to-1 setup, right? That's very high. For every $1 you're risking, essentially you're looking to make $4. That is awesome. You have 130 days of expiration on this play, and this is well within the reason of can it hit in the money and potentially hit max profit? Absolutely, assuming ER moves in your favor. There's enough time here for this thing to get up closer to 165. There's a 66% chance that this thing hits 50%. The chain likes this play. I like this play. This is probably going to be the one that we end up taking inside of TTI, but something to consider here. Once again, if you're looking to reduce your cost basis, spreads are a great way. Let's go out one more towards those Decembers, and let's play around with that 170 idea, right? So right now the market is not pricing this in as very highly. It's outside of the 1 standard deviation band, which means it's unlikely to hit. And you're grabbing them right now for about $115. This is about the same risk as those October 160s when you look at the P50, 46 cents here. 46% chance of a 50% move. It's around the same, but you're getting a whole bunch more time on these plays, the 158s. So realistically, I like that November play the most, but the December contracts are alluring to me. You could grab the 160, 165s. You're getting around a 4-to-1 setup. Maybe the 165s, 170. Something we do is we like to buy the end of the chain prior to the standard deviation. And then the next one, sell it, right? Because this one obviously is outside of the statistical norm of what something can hit here. So if it does hit, that's great, max profit. If it doesn't, obviously we make money if this thing goes to zero. So $72 max loss there. Max profit of 428. It's about a 5-to-1 setup. 62% chance of a 50% move. There's a lot of different ways we can attack this JPM chart, but I really do like those November 160, 165 called debit spreads. It's a good mix of risk to reward. That 4-to-1 setup is absolutely what we love. It's a little bit more than that. It's about 62% chance of a P50, which is good. 22% chance of profitability on the overall spread closing in the money. I think this is a great opportunity to grab a leading financial name heading into earnings season. Once again, I have no idea what's going to happen here. But I do know that if you were to buy those call debit spreads, you're going to reduce your overall risk in the event that ER does not work out and JP Morgan comes down and get stopped out. Like I said, we want to stop out sub 135-ish, 134 and some change. We're targeting 160 to 165 with those spreads, but the ultimate goal here is potential all-time highs in JP Morgan. So if you're looking to go out there in those Decembers or potentially even farther, you know, the TA matches up. Last thing I'm going to say here is at 100%, something we do inside of TTI is close half of those spreads, contracts, whatever you end up buying. Close half. That essentially turns your trade risk-free. Allow the other half to continue to ride to your profit targets. It's way easier to emotionally manage trades when you're playing with house money. Guys, if you like this type of content, please like and subscribe. Let me know what you think about this JP Morgan play. I'll catch you in the next video.